So we're going to talk about managing the trades with a bear call spread. As with any trade, there's two stages to managing a trade. The first one is before you even place it, and then the second part is when the trade is on, what do you do after that? So here's the first step: picking the strike prices before you've even placed the trade. And the strike prices that you pick with a bear call spread largely depends on how bearish you are. So if you're very bearish on the stock, you think it's definitely going to fall, well, you make sure that both calls in that situation are in the money. In other words, the call strike prices are below where the current share price is at. In that situation, you're going to profit a lot more if you're correct. If you're wrong, you won't win at all. In the situation where you're moderately bearish, that's where you would have the share price in between the long call and the short call. So the share price is in between both strikes. That's where you're moderately bearish. And then if you're least bearish of all, that's when you'd have both calls out of the money. In other words, the strike prices are above where the current share price is trading. You're more likely to win in that scenario, but you won't make as much money. So it really depends on how bearish you are and how much you want to make on the particular trade. And another situation to take into consideration: the wider the strikes that you place, the more profit you make, but also the more risk you take. So remember that when you're placing the bear call spread. So now, assuming you've got your trade on and the share price is going exactly the way you want it, it's below the short strike at expiry, you've got absolutely nothing to do. What will happen is, on the Saturday after expiry, the bear call spread will simply disappear from your account and you will just keep your full profit. So there's nothing to do in that scenario whatsoever there. However, if you're at expiry Friday and the trade is losing, you've got two choices. You can close the trade down for a loss and just take the hit and move on. Now, if the share price is trading above both strikes, in that scenario, you can just leave the trade and it'll cancel itself out on the Saturday and you will lose. Or you can close it down early and incur some of the trading commissions. It's up to you what you want to do there. Or what you can do, and what we tend to do quite a lot, if we still believe in the trade and we think eventually the shares will drop, we will roll out this trade for more time. And we were going to show you how to do all of these in the next section. And we're going to show you how to do all of these in the next section when we're talking about trading these options on the trader workstation. So you can roll out for another month to give yourself more time for the trade to work out.